Hi, this is James Shugg with the Westpac end of day report for Wednesday, September the 21st. Mostly it was about the Federal Reserve decision in the US today, and I'll get to that in a minute. I'll first quickly run through though what happened in European markets during the session here. Pretty bearish actually. We saw disappointment emerge on the basis that the Troika, that's the EU, ECB and IMF officials, will be going back to Athens next week to try and nut out a resolution to the Greek sovereign debt problem. Earlier this week there had been positive sentiment related to the fact that the talks had been described as having made progress. Today we saw a sell-off worth 1.4% on the London market, 1.6% on the French market and 2.5% on the German market on the basis that they may have been progress, but there wasn't a solution reached. Also, the IMF has estimated that European bank losses related to the sovereign debt crisis in Europe could amount to around 300 billion euros. So a significant hit to the European balance sheet in prospect. The other issues to run through, as the cleaner walks right behind me, is, and puts me off my pace a bit, so that's where we stood as European markets closed. We also had in the UK the minutes to the Bank of England September meeting where the majority of the committee acknowledged that the probability of the need for further quantitative easing had increased. You read the minutes and you get a very strong feel for the fact they could even fire up the QE program here in the UK as soon as November this year. Our official view at Westpac has been that they wouldn't start it again until probably January or February 2012. So they're the main events in Europe. On the US side we had a jump of 8% in existing home sales in August, but then it was to the Fed. And what the Fed has announced is that because they see, let's see, on the risk side, because they see that there are significant risks to the economic outlook, including strains in global financial markets, replacing their earlier comment back in August that downside risks to the outlook have increased. Given that, and given that there's been no bounce back in the slowing growth story and deteriorating labour market story that they noted in their August statement, they've decided to foster economic recovery by buying $400 billion worth of longer dated US Treasuries over the next 9 months, financed by, or if you like, sterilised by, I suppose, the sale of an equivalent dollar value worth $400 billion of shorter term maturities. That's less than 3 years. So the longer term ones being 6 to 30 year Treasuries. And what they've also said is that they're going to reinvest maturing mortgage debt back into mortgage-backed debt, back into that market rather than switching it over into Treasuries to provide a bit of support to the housing finance market. On the basis of that statement, the US equities actually sold off, probably because of this sense that the risks have increased to the downside. Whereas the Dow was down about 0.3% before the Fed statement, at just after 8 o'clock in London, it's now down about 0.9%, okay, at 11,309. The Aussie dollar's taken a bit of a hit today as well. It's down around 1.01 or just over 1.01 against the US dollar, having lost more than a cent since the interest rate decision or the statement from the Fed. And commodity prices have tended to fall as well since the Fed decision. We're looking at, for example, gold prices down 1.8%. Sorry, 1.3%. We've got gold at $1,786 an ounce. Copper prices, which are up 1% before the statement, are now unchanged, and oil's fallen around 2% at $85.39. I think that's it. Apologise for the slight disruption there from the cleaner, but it's getting late and I didn't want to start the whole thing again. Watch out for Assistant Governor from the RBA, Lowe. He's speaking to a bunch of economists later today, Australia time. So something might emerge from that. Okay, I'll speak to you again tomorrow.